Hello, and welcome to Startup Club again. Almost 1 million members strong. Our club is, hey Pierre, how you doing?
Hi guys, how you doing?
Hey, you jumped on quick. I knew I had to be quick today because it's important that we open the room. Michelle, I'm going to set you up there as a moderator as well. Well, I have to
Excellent.
tell you, I'm so excited about today's show. As I was mentioning, Startup Club's almost 1 million members strong. You can check out
Nice.
Yeah, you can check out www.startup.club and actually join our email list as well. Our club is run by our CEO here, Michelle Van Tilborg, Mimi Ostrander, who writes great blogs for Startup Club, and Olivia Valdez, who runs marketing. My fellow moderator as well, Jeffrey Sass, he might be coming on today, I believe. And I'm Colin C. Campbell, and you're listening to Serial Entrepreneur Secrets Revealed. Yes, we have rebranded to that title. It used to be Serial Entrepreneur Club, but we have rebranded Serial Entrepreneur Secrets Revealed. And you can find that in your favorite podcast channel. Yes, we are a live show also, but we syndicate through podcast. And I think you can get it from Apple, iTunes, Amazon, whichever podcast format you use. The team here has done a great job of just making certain the show gets syndicated. We have so many great speakers like Pierre come onto our show, and I want to make a special pitch for last week. And Michelle, I don't know if it's live yet or not. Hey Jeff, I don't know if it's live yet. Last week's show in the podcast network, but uh, if not, you can get it here on the
It
replay.
is.
It is all right. That's great.
Yes.
We had just such a phenomenal time with George Walthier, who talked to us about power talking. Came up with about 50 very unique phrases that really can have a huge impact on your life. So, if you get a chance, consider listening to that episode. It was a killer episode, and I know it's going to be like that today as well. We're all talking about the exits, and I've been fortunate to have exited more than 10 companies in my life. Last year, Jeff and Michelle and I sold Dot Club to GoDaddy. I mean, it was a circus. It was a 4 month circus, Pierre. So craziness.
I can imagine, yes.
And, it was funny because it was like, one lawyer on our side, and then we had one outside counsel. We eventually added a second outside counsel, and they had like 30 people on their side trying to buy this company and, going through due diligence and going through like the contract negotiations and then going through schedules and finding every document. And, so I'm really hoping today that you can help us sort out the chaos when it comes to an exit. And what should we be doing from the very beginning when we start the company? So we're excited to have Pierre. I'm gonna maybe hold back saying your last name,
Yeah, no
Hurtabiz.
worries.
Hurt,
After biz, exactly.
Ertebiz. I actually have somewhat of a French background. Ertebiz, Canadian French, a private equity and M&A professional, and he's going to help us figure all this stuff out. Before we jump to you, Pierre, Michelle, and Jeff, I'd love to hear like what your thoughts were about the exit. We'll kick it off with ladies first, Michelle, about with Dot Club, and your thoughts on it and the stress that you went through and everything, and then Jeff, and then we'll hit it with you, Pierre.
All right. So I'll go ahead and start. Um, yeah, I'm going to say I have so many questions for you, Pierre, but as Colin asked, I'll just give my a few comments about what we just recently experienced. For me, I will say it was very gratifying. I know that might seem weird. It was stressful, but I found it extremely fun. Um, I will say the reason probably I found it fun was a couple of reasons. We knew it was a really great company that we were selling, but we also had a very strategic buyer. So, what I really took away from the whole process, other than the usual, operations and mechanism, mechanics of the whole process being organized, was is that we had an amazing team. We had been working with GoDaddy from the very beginning, so it was very rewarding because it was something actually that we had been working toward from the very beginning, which was at the exit, we really wanted to make sure that we found a buyer that truly could take the company to the next level as well as people that we like to work with and talk to. So, we continue to work with GoDaddy, on a certain level. And I would say, if you can, think in the beginning, what is your true value, right? And who could you add the most value to? And for us, we knew it would be somebody like a GoDaddy. So we really nurtured that partnership and that relationship. And it was for the benefit of all the shareholders and the employees. So that's my takeaway, if at all possible. Just when you're even starting, think about who your partners are, because you know what? They're your best candidate for your acquirer. Thank you.
They clearly are. I think it's great that you managed to get that thinking about the exit and making sure that you have this relationship with the potential strategic partners, because it makes the whole conversation so much easier and the whole process so much easier if you have a previous relationship with them. And I'm curious to know, like, talking about that exit that you had, what were the main pain points and the main thing that surprised you during the process, guys?
Why don't we give Jeff a chance to jump
Jeff
in,
is
Michelle?
he's not going
No,
to speak. Oh, go ahead.
no, I'm here now, but I have just a few minutes, and then I tied up for a few minutes, and I'll be
Ah,
back.
okay.
But the I think the point that Michelle made too. There's two things that I wanted to mention. One is these things take a lot longer than you think. It appeared to people that this deal we did with Dot Club and GoDaddy happened very quickly, when in fact, the seeds of those discussions were planted, you know, literally years before the exit actually happened. And that ties into what Pierre, you and Michelle are talking about, it being a strategic um, deal, because that partnership started very early, and discussions and hinting toward a potential transaction happened very early. The other thing I want to mention is, when you have an exit, it's part of your legacy as an entrepreneur. So it's important to think about not just a good exit, but a good future for the company, even beyond your continued involvement. What's really exciting is when you have an exit that is beneficial for you, your employees, your investors, but at the same time, truly beneficial for the future of the business you created. There have been many situations where someone may have a financially successful exit, and then after they're gone, the company is shut down or absorbed or dismantled by the acquirer. And while that's okay financially, perhaps for the founders, from a legacy perspective and just from a satisfaction perspective, that might not be as good. So I think you want to find a partner and a transaction that's going to both benefit you, your employees, your investors, and at the same time benefit the future of the company.
Yeah, okay. So I'll try to add some pain points into there. Michelle, did you want to go first again? I know you were ripped to jump in.
Well, I was just going to add on to what Jeff was saying. I've been also a part of several acquisitions. And one thing Jeff mentioned was employees. And that can be, a sticky situation, because the fact of the matter is quite oftentimes employees do not stay with the acquisition, and that presents a lot of anxiety for them. So what I would recommend to people is you be very clear as quickly as possible with the acquirer, and then when it's appropriate with employees, and treat them well. And that really, I've experienced it both ways, very poorly and also done very well. It really does help, and it makes everyone much happier. Thank you.
Yeah, I'll just throw in a pain point because Peter, you had asked us to think about pain points that we had during the exit. I think one of them was that the negotiations went much longer than we thought. Jeff alluded to that in what he had said. And the level of the contracts were very, very high. And it just took a lot of resources from the company. And what that did is it takes us off our game. We're no longer expanding the company and focused on that. We're focused on just getting through this process, which I would estimate it was about 4 months, 4 to 5 months, the entire process. And there were
Which
no
is typical.
weekends and were no evenings. And it was very, very intensive. And there were moments when I had to kick one of the lawyers out of the room, and they said, look, I'm suspending you for 3 days because you didn't do your job or whatever. It was just very intense. And the stress, and I think the way that you go through that as an entrepreneur, you're trying to run the business, and at the same time, you're trying to sell the business. And there's also a lot of emotional aspects around it too, because this business has been your identity for the last 10 years, and now it's gone. You no longer are the founder of this company anymore. So Pierre, I'm curious from your perspective, like what you think some of the other pain points are during an exit, and then we'll move on to maybe how can we actually help avoid these pain points. But I'm curious if you know of any that we haven't
Clearly,
covered.
I think all the points that you're making are great points because they happen on every transaction, and they're also one of the reasons why it can be very important for you, to have an advisor or several, because first, as you say, you're emotionally involved because that's your company. So having someone that kind of act as a third party and can be the bad guy in the negotiation without impacting your relationship with the seller, especially in the case where you continue working post-transaction with the seller, in itself is super important. The second one is helping you focusing on the business. If you can delegate and have someone really doing all the groundwork on the negotiation so that you don't have to think about it day and night and you can still grow the business while the transaction is happening, is also a great value. And generally, a lot of people underestimate the time the transaction will take for several reasons. The first one is negotiation, as you said, because you feel like once you've negotiated the price and you've negotiated maybe like the net debt and how long it will take you to get paid, the structure / the earnout, you think you're done. But generally, this is only the first step of the negotiation. That's to get to the LOI phase. Once you've signed the LOI, that's when real things are starting to get nasty, because you start having to deal with the lawyers and to go through every point of a sales and purchase agreement. And if you just look at the price that you've agreed on, it's at that stage you still haven't covered, okay, what's your current net working capital, which has an impact on the final price which is paid. Because generally when you talk about price, you talk about enterprise value. And what you're actually going to get on your bank account as a founder, as a seller, is going to be your equity value. And your equity value is impacted by your net debt, by your net working capital, and could be impacted by off-balance sheet items as well. And so for
Yes, Pierre. So you're sort of
yes,
like, yeah, two big concepts there. The first one I think you're
yeah,
talking about is the idea of having someone else help you with the transaction. So it's very interesting. I've used brokers many times on my exits, and sometimes I haven't used brokers. And it was very unique that we did not use a broker for .club. It was only, I think it was only because we had established a relationship with the buyer from GoDaddy Registry. I should be clear, it's not GoDaddy, it's GoDaddy Registry. But
okay,
we had established the relationship, and we were able to do it with that, do the transaction without a broker. But I've used a broker a lot as well, and most of the times the broker's been great at really cleaning us up, and not the other way around. It's more like cleaning us up and presenting us in the best lights with the best type of numbers and those kind of things. So can you talk a little bit more about broker or not to have a broker?
yeah, clearly. And I will actually start by making a differentiation between the three types of service provider that you have in M&A. You start with brokers. That's, I would say, generally I compare them more to real estate agents. They're here to kind of clean the house, to reach out to as many people as they can, to facilitate the conversation. They will help a bit with the numbers, but depending on how professional they are or how much financial background they have, they may only be the middleman or help you a bit with the numbers, but just only to a certain extent. Then generally you have the next one, next level, which is going to be the M&A boutique, where generally it's going to be more professional. And again, some brokers actually do the same job as M&A boutique, right? So in the situation by situation basis, I'm just trying to give the general landscape. So M&A boutique, you generally have several people working on the company. They're really going to do their research to understand the full company. They're going to do a full IM with 50 pages, and they'll be able to pitch the company almost without you.
Sorry,
And
Pierre.
then,
IM. Can you give? What does that mean?
what that?
You said the full IM.
Oh, sorry. Yeah, yeah. No, don't hesitate to jump in every time I
Yeah, no, I'm going to do that. I'm
understand.
trying to
Yeah.
translate your language, right?
I,
IM.
IM is basically investment memorandum. So that's all the documents that you use to pitch your company. You generally have two main documents. The first one is your teaser, which, depending on how you want the process run, most of the time is confidential. It doesn't include the name of your startup, and that allows you to approach everyone you want on the market without compromising your confidentiality or the data you don't want to share with everyone. And then you have the full pitch deck or full investment memorandum that clearly articulates the story of the company, shows the numbers in the best light possible, and really is a main pitch document that buyer will use to form an opinion and basically offer a price or not on your company. So it's a very important document. And
Got it. And you said there's a third. You said there was a third
yes,
level. Yeah.
exactly. And then the third level is going to be the investment bankers, which in nature do a very similar job than the M&A boutique. The main difference is M&A boutique, you generally have just a couple of advisors, whereas investment banking, they're generally banks who have a presence in different countries, so they have a larger network and they can reach out to more people. And they're generally also involved in bigger transactions, right? Because they are more used to run like a bigger process. But generally speaking, from my experience, with the investment banking, you're going to have the larger network. With the M&A boutique, there you're going to have more seniority on your deal because the more senior people will help you out throughout your deal. And with the broker, you have the lighter version, which can be fine, especially if you're, say, below 5 million in annual revenue.
That's a good question too. Like, what is there a size where you're too small to hire a broker? Is that what you're saying? Like, what size do you hire the broker, and what size do you go to a boutique, and at what size do you go to an investment?
Yeah, I think there is not a size where you wouldn't benefit from having someone helping you out, except if you're really small. Especially because generally they're going to charge you a percentage of the price you get out of the transaction. But most of the time, if they're good broker or M&A advisors, you're more likely to have a higher selling price by using them. So most of the time they actually pay for themselves. So that's a no-brainer on that front, as long as you can find a good one, of course. Generally speaking, say if you're sub 5 million in annual revenue, you're going to look at either broker or M&A boutique. M&A boutique is going to be more expensive because most of the time brokers charge only a success fee basis when M&A boutique have a retainer because they have more resources, they spend more time on it. So yeah, they're going to charge you anything from, say, $3,000 to up to $10,000 a month just to help you out, plus a success fee. And investment banking, I would say you start looking at them if you're above 5 million, 10 million in annual revenue.
Got it. So, and then what percentage commissions, like roughly, would you be paying out to your broker or M&A or mini,
Yeah.
whatever?
It's also highly dependent on the size of the company. I've seen several brokers focused on the micro cap market, so internet companies that do less than 1 million in revenue. They charge up to 12% of the sale price.
Holy shit, that seems a little bit high. That to me, that seems like you worked your whole life, and they come in at the end and they get 12%.
Exactly. To be fair, coming more from the M&A side and M&A boutique and private equity investment side, I thought 12% was insane, but they actually managed to charge that. And also, I guess the upside of it is when you have people like FE International, for instance, they're like
Sorry, can you say that again? F what?
FE.
FE International. Okay.
Yes,
Yeah.
they're
Okay.
one of the famous online brokers, and they generally do like a pretty good job. I've seen their IM; they are fairly standardized, but they do a pretty good job overall. And they have like a huge network because they managed to build that network of investors, basically of buyers. So if they already have the marketplace, sure, you're going to pay them 12%, but you're more sure that your business is going to be sold fast, I think. However, generally speaking, if you go above 1 million, um, you're more going to be looking at between say 4% to 8% success fee. And if you start looking at companies that sell for say 10 million plus, then you can go down to 2 to 4% of the transaction.
All right. Well, I'm going to change the conversation here a little bit. You know, a lot of us, we have smaller startups, but they are significant, right, for an exit. And oftentimes, the way it ends up going is, you know, not that we're sending out a memorandum like you mentioned, but people approach us. And a lot of our companies are that way where people, you know, are approaching us all the time, asking us to discuss selling the company. So I'm really curious, you know, to ask you what you would recommend to us. Um, you know, oftentimes, you know, if they want you do an NDA and then they just start asking you for all this information. Like, what would you suggest to people that are getting emails or calls and you know, folks are just trying to discuss, hey, you know, what would you sell your company for? Like, where would you start if you were, you know, let's just say a small to medium sized startup and people are asking you what your price is?
So the first thing I would do first is keep an Excel file or any file where you keep the contact of all these people with their emails, right? I know it doesn't answer your direct question, but I highly recommend you to do that because if you're not thinking about selling now, but people keep on coming to you, and 2, 3 years down the road, the day you want to sell, it's going to be super helpful to have that list of people you can just reach out to immediately. So super valuable to do that and not really time consuming. Now, in terms of how do you handle those calls, uh, it depends. It really depends on your state of mind. If you already have a number in mind and you know that you are at that stage where you love what you're doing, you don't want to sell right now because you can continue growing the business, which is generally the best position you can be in, then you can ask for like a crazy number and basically say, oh, I don't know, like I don't want to sell now. Right now, I would only be selling at 8 times, 10 times revenue, for instance. So then you just shot your shot and that's it. And generally speaking, if either you have a very good strategic interest for the buyer and is going to entertain the conversation, and then happy days for you, or is going to be above expectation and you're not going to waste any more time and you just keep the conversation going by or the relationship alive by saying, look, we're not really looking to sell at the moment, we'll contact you later. Generally speaking, also, when people ask you for how much you want, if they're the one reaching out to you, I mean, you don't really need to give them a number. At best, if you want to give them something, just give them a range, right? Of, but at the end of the day, if you're really thinking about selling your company and you're privileged enough to have enough inbound interest, then start structuring the process a bit, either by using a broker, as we say, but if you want to do it yourself, try to set a timeline to everyone, um, to, talk to each individual inbound that came to you and try to put them in competition, basically. So you would prepare first the data, send them out the data they need, and based on that, ask them to do evaluation of your company or to come back to you with a proper LOI offer before dedicating any more time to it. It's all a balance between being able to give them enough so that they can value your company and not spending too much time putting together data that takes you away from your business.
Yeah, that's
I,
great. And sorry, Jeff,
No,
go
I had
ahead.
another question, kind of almost the flip side of valuation is if you had any thoughts, Pierre, on determining how much money to raise. Because in my experience, I remember we were going through a raise for one of the companies I was involved with, and we were the amount of work, everything that you described, Pierre, and everything Colin and Michelle have been talking about, all the work involved in preparing for and
Mm.
executing an exit. It's the same amount of work whether you're raising $5 million, $500,000, or $50 million. The work is almost exactly the same.
Very true.
The only thing different is the numbers. So if you're going to put the work in, how do you determine, what would your recommendations be to determine how high you should go in terms of what amount you should be raising?
As a financial advisor, I generally pull out my Excel file and put the number in Excel when I'm trying to figure out something like this. Because as with everything, this is an art. It's not a science, and you will never have like the perfect answers, and you will never have one answer fits all. Because the balance is between exactly what you're saying, the fact that it takes a lot of time to raise money, and on the other end of the balance, you have trying to maximize the dilution, so the number of equity you're giving out at the point in time. Because obviously, if you raise 5 million now and 5 million in 2 years, the second 5 million are likely going to be raised at a much higher valuation. So if you raise a 10 million now, you're going to dilute yourself way more and sorry, and lose a bit of value of the company. So it's all about finding the balance between what your first figuring out what amount of money you really need. What do you think will be the value you will get out of that money? And trying to find the perfect amount that will keep you going, but also allow you to really reach the next step of your company to have a significant gap in valuation. Said otherwise, if you think that with 1 million you can increase your sales and develop a product so that you think you can maybe win 10% or 15% in terms of valuation, maybe it's not worth it to go through two subsequent raises. If you think that with a certain amount of money you can double or triple the value of the company, then maybe it's worth it to raise only the amount you need and raise a subsequent round 2 or 3 years later.
Pierre, I think we're going to have to bring you back for another show so we can talk about raising capital because you have an enormous amount of experience in both the exit and the capital raise. But bringing it back to the exit, who's like, how do you find the buyer? Like, does the broker go out and get the buyer? Now, obviously I know a little bit of this area as well, but I'm sort of setting up the question. But does the broker go out and get the buyer? Do you bring the buyer to the broker? Do you pay a different commission rate if you bring the buyer? Can you talk a little bit about that?
Yes, for sure. Um, so I'm going to try to answer your different questions. You asked two or three in the same one. So first, how do you find buyers? So it's not rocket science to be fair. I'm not even going to pretend that we have a secret formula to reach out to buyers. Is first people from your network that you know, because the more you've been in business, the more you've talked to people. And it's especially true and easier to do with private equity groups because they're investing in a wide array of industries. So if you already have the connection, it's much easier to reach out to them. But you've talked also to different strategic buyer, and you have people in your network that you've never used to that point, but you know that work in the industry that you can reach out to get an intro, etc. Then the second one is simple outreach. Same way you would do sales, you identify all the main strategies that you think would be a great addition to the buyer list. You're trying to really think outside of the box because sometimes you have strategies that don't seem that obvious, but thinking about it, they're big enough that they may have a specific department or a specific strategy you're not even aware of where your startup and your product would fit well. So you're really trying to build that list, and then you do either intro through through LinkedIn because you have connection in common, or you do cold outreach. And you can use Twitter, you can use LinkedIn, you can use email, the same way you would do outreach to customers. And the
So
other
who,
way,
Pierre, who are we outreaching to? Are we outreaching to competitors? Are we outreaching to private equity? Are we outreaching to strategic buyers? I know obviously it's from my experience selling to a strategic buyer gives you the highest multiple, and
yes, it does.
private equity the lowest in my opinion, lowest in competitors the second, and we can depack that maybe later on in the show. But like, who do you reach out to? Like, which of those groups do you focus on? It's hard to, it's obviously hard to find strategic buyers because they're not even in your industry. They're coming in and they're, you know, they're trying to find ways to leverage their customer base and attach your services to that. But what are your thoughts?
Yes. So to figure that out, the first thing I do is actually having a conversation with a client, with my client, with a business owner, because they're the one who knows the business and their industry is the best. Like we never claim that we're better at understanding the market than they are because they live and breathe on their market. So there's a better position to tell you the top 10 or top 15 best case scenario buyers out there. Based on that, then you start expanding. So looking at the competitors of the strategic, looking at similar industries, looking at different geography as well. Depending on whether you're specialized in an industry or not, you can also, as an M&A advisor, be aware of who is very active on the market, who buys out those type of company, etc., etc. But generally speaking, except if the seller have super specific needs for selling his companies, and you guys talked about legacy before. I have clients who are like, oh, I only want to sell to a strategic. I don't want to sell to a PI because I really want, the name of my company to thrive, and I only think a strategy could do that. So if you don't have any specific need and you just want to find like a buyer have the best offer, then you reach as many people as you can. So you're looking at competitors, you're looking at product of substitution, you're looking at even even sometimes subdivision and subdepartment of bigger group, which happen a lot, for instance, on the internet industry, because you have like huge companies. SAP, for instance, SAP, they have corporate ventures. Like if you don't know that, they may have sub-department you've never heard of and that are actually investing in the specific industry that you're on. So it's worth it to do your research and trying to understand who's active on the space. And most of the time when you do that, you will have people that you don't necessarily see it. You're not sure whether they're a good fit or not. My base approach is to say, okay, if you're not sure, just put it in the list. Because at first, that's why you have the teaser. You have the teaser to reach out to them. And then based on those first conversations, then you're going to be able to gauge and to judge whether they're actually a good fit or not. And you can get there without sharing any confidential information. So it's just more time, and generally that your advisor will put on that extra time.
Wow, we're getting a wealth of information today. This has been really good. Let me reset the room, and I know there are some in the audience who would, I'm certain, want to come up and ask some questions. If you are interested in coming up, please raise your hands. It's time to come up, ask some questions. We're going to shift a little bit here towards, what can we do from when we start the company to make that process easier. And I always say it's important to think about the exit the day you start
Yes.
and try to visualize it a little bit. And there are some things you can do. And I'm curious, Pierre, can you give us 5 tips or 6? I don't know. You got the number in your head probably, but what are the
Yeah.
things we should do when we start a company?
True. Well, always good to keep it in mind to think about the exit from the start. However, from experience, because I'm more from a world of like big corporation with a lot of processes where every time I do something, I'm trying, to think 5 years ahead of time, making sure everything is neat and organized. honestly, now that's been or more on the entrepreneur side for the past 3 years. I think it's important at the beginning to really focus on your product, getting product market fit, getting out there rather than spending too much time focusing on the process or on getting to structure. I think it's more important to generate your first dollars at first than getting structure. However, as soon as you start generating those dollars, then start adding more processes because it's really going to help you grow. And specifically regarding your exits, so one of the first thing is to put some effort into your financial reporting. Like the main thing we see, even with company, like I'm working with a company that does $5 million in ARR, their accounting is not that great. Their reporting is not that great. They are not able to give me like a very specific or precise CAC, customer acquisition cost. So metrics that are super important, even though they reach a considerable, I mean, a sizable size in terms of revenue, they're not still perfect. So if you can do that, if you can focus early on having a clean reporting, understanding what goes into your number, is going to help you first when you sell because people can trust your data. And I think one of the number one factors that will help you sell your company is whether the buyer trusts you and trusts your number. So early on, try to make sure you structure that. Second, if investors or buyers look at those data, is because it helps them understand your company. And if it helps them understand the company, it should help you understand your company. So structuring your company from a financial and data reporting perspective is not just only beneficial for your exit. It's going to help you manage your company as you grow. Really understand where you're creating value, where your pinpoints are, and where you should be focusing on. So from that perspective, I think it's super important for a lot of different reasons to focus on that. And you don't need a CFO from the start. Just get, I don't know, head of finance at least, or a financial FPA, like even an FP analyst, someone who's used to work with accounting, used to work with Excel, who can pull together a few analyses and help you clean your data and make sense out of it, would be super valuable. The second thing is, sorry, you want to say something?
Well, I'm going to give you a chance to take a breath here,
Yeah,
right?
yeah, yeah. Thank you.
And maybe you can, if you have a couple more, that would be great. And we'll jump down to Daniel next. But one of the pet peeves I have about every company I've sold, it seems like every freaking. I thought we were ready for .club, and we weren't. And you can't find this contract, you can't find that contract, you can't
Yeah.
find this document, that employee agreement. I believe from day one you should set up a virtual drive. It's almost nothing, whether it's the Microsoft one or whether it's Dropbox. I don't care what it is. An organized virtual drive, which eventually can be your due diligence box. By the way, if you had everything uploaded and organized from the beginning, I mean, you could just give them access to this box and they could go in. If there's multiple buyers, they could just go in and review. And it's so easy. And I can't tell you how many weeks or even months we spent trying to clean up this stuff, at every company I've ever sold. So virtual drive from the beginning would insist that if you have an admin or on staff that they scan every document. Now I know today everything's virtual, but that could almost be worse because at least we used to have a filing cabinet. Now somebody will say, well, where's the agreement that we had? Well, it's in my email. Well, my email deleted. Oh, I'm just saying, a virtual drive, organized. I think that can be one of the that can be maybe number 3 or 4 of the ideas here, and I'll let you add a couple more, and then we'll go down to Daniel for a question or a comment.
Clearly. But another thing, it's mostly regarding the acquisition itself. It's a lot about the quality of the information and the organization. And also what you're mentioning, having those documents is also going to be useful if you have a tax audit, for instance. You're going to do it at some point, and you don't really want to be caught off guard if you start getting audited. So at the end of of the day, it also helps you prevent any malfunction in your business if you do it from day one. Sorry. Uh, Another thing that can help you sell is if your value proposition is very clear. Because, sorry, I've been talking like the past 3 days at Web Summit, so it's starting taking a toll on my throat. Uh, like several things I've seen with businesses I talk to is people launching several products which are totally unrelated under the same company. And so they start pitching to you that they have a $1 million company, but effectively they have like one product, and they are generally SaaS product because I mostly work with SaaS companies. One SaaS product that does 300K, one SaaS product that does 700K. But you as an investor, you or even an acquirer, you may be interested by only one of them. And so if they had kept from a legal perspective the product separate, that would make it way more clear, way cleaner to be able to buy the product you want. Because instead of having all shared costs, because that's generally why you want to have several products under the same entity, is because so that you have your fixed costs, your admin costs, your legal costs are shared. But you can share those costs and still have two legal entities, and then you just need to recharge the cost. But for each of them, you have a clean P&L, which makes it way easier for anyone to buy out your business.
Wow, that's amazing. All right, Daniel, you've been patient. Do you have a question, or do you have an exit story? And by the way, I didn't mention that earlier, but if you are in the audience and you've exited a company before, this would be the time to share. Look, this is Friday afternoon. We're all having fun on stage, and I know there's a lot of experience in the audience here. And if you really want to share that, please raise your hand and come on stage. Daniel, do you have a question or an exit story?
Hi, Colin. Thank you for having me here on stage. I'm surprised the value that you guys are bringing. I wish we had like 500 people because
Don't
a
worry,
lot
we're
of
going to
people
get
is
there. We're
here.
going to get there.
Yes.
And we're happy
Yeah,
to know that the podcast is starting to take off too. So, it's like live radio. You do a show and then it takes off through different channels as well. But really, I agree with you, Daniel. I think every week we come, like Pierre's amazing and he's taking his time to share this
Thank you.
with us. And then Mimi takes it and she puts it into a blog, and we have recordings on startup.club. This is brand new though, right, Daniel? So we're building it up from here, and we're gonna hopefully help a lot of aspiring entrepreneurs.
absolutely. And that's why, I'm amazed the value that you guys are bringing. I think is going to take off in a really, catalytic way, like Supernova, because you guys are bringing amazing value. But, I just want to say thank you for the value first. Secondly, is yes, I have a question. I don't have an exit, unfortunately, but I have to be prepared in the case that will happen, right? The startups that I'm launching are not. I'm not planning to launch my startups and my projects to exit them. I'm planning to go with them and grow with them. But it's always better to be prepared ahead, right? Just if there is something that comes along the way and then you decide to go in another direction. But so that's why I think um, this has a lot of value, and we can prepare as much as we can, and there's always things that we're going to find out along the way. um, so my question is, um, when is a good time for a company to decide to exit? So for example, let's say your first year you are profitable, you're made your first, let's say 100K or whatever on sales, and then the next year you make 200K. So when you see a growth on at that level, like you have a growth, and you can potentially continue to expand that growth to other levels if you continue right on that direction. Yeah, I understand sometimes scalability, It's you get to a point that you have to go for funds because you need to. But when, but before you get to that point that you have no other choice, is when do you realize, okay, this is an opportunity, this is a good time for me to look for an exit.
Yeah.
That's my question. Thank you.
So there are several way you can think about that. Several type of answers. The first one is psychologically speaking. For you as a founder, how much do you enjoy what you're doing? And the reason why I'm very familiar with that is one of my flatmates has founded a startup, and we had a conversation with him last month. Basically, the guy has raised his Series A, now he's raising his Series B, and we asked him, okay, is there a price right now at which you would be selling? And he said, oh, 500 million. But even at 500 million, he would not be happy to sell his company because he loves so much what he's doing that what he was actually saying is, I would only sell for an insane amount of money because my life is great. I'm at a point where I have a decent pay, I live well, but most of all, I'm obsessed with what I'm doing. I truly believe what I'm doing can change the landscape on which we're going our company. I think we can become the next, maybe not Facebook, but the next Twitch. And basically, is not even for him now is not the right moment to sell. So for someone like that who's really passionate, the best moment to sell is when you start being a bit annoyed with what you're doing, being a bit tired about what you're doing, feeling like you would like to move on to the next project. Then that's generally a good clue, and that's from the psychological point of view. The second answer would be from a financial perspective and how to optimize for financial exit. So it's all about the balance between risk and reward, as always. You always think that you can grow your business faster, and most of the time, you have the indication to think so, but you know that it also bear a certain level of risk. And I think the past 3 years have really demonstrated how everything can change overnight because of things that are totally outside of our control. But overall, if you want to optimize the price at which you exit, it's best to try selling your company when you're growing fast and you're profitable and you have great revenues. Because if you start having a decrease in your growth, then buyer will see it. So it's much better and much easier for you to pitch the potential of your startup if you can actually demonstrate accelerating growth. And now, yeah.
Yeah, and I actually wanted to add to what Peter was saying. Pierre was saying.
That works.
Yeah, there you go. In regards to the timing for sale, one thing that I do think that every startup should think about is when they're in a position to sell their company to a strategic buyer. When they're in that position, then they should seriously consider the offer. And I'll tell you why. And I've been on both sides. I've bought probably 20, 25 companies in my life, and I've sold, as a major shareholder, about 10 to 15 companies. I don't even remember. But the fact of the matter is, a strategic buyer is going to come in and give you a valuation much higher than you can generate in profits on a go forward basis. So, for instance, and this was a public deal, so I can talk about this one. In the 2000s, when we sold Hostopia, we sold it for $124 million and it sold for 17 times EBITDA. Now, just think about that for a minute. And remember, we still have to pay taxes on our earnings, right? But so we might have been selling for, if you really think about it, 30 times earnings after tax. It would take me 30 years before I would get all my money back from the sale of this. Now, of course, you're gonna have to pay taxes on the capital gains, and don't want to diminish the taxes. We'll just try to remove that component from this conversation. But the fact of the matter is, it could take us 20 to 30 years to get our money back by not selling. And why did the company buy us? They bought us because they had 3 million small business customers that they were going to take our platform, our services, and leverage it across their platform. So I think that's the first thing I'll say about the timing of a sale. The second is that when things are good, And I made this mistake as well. And I'll be honest with you. We were talking to two buyers last year at paw.com, and we're like, we're Inc. 5,000 3 years in a row. We'll just double it again next year, and we're just going to build it up so we can get to 100 million, 200 million, whatever value. And yet, what happened in the last 12 months? You had a war, you had the economy crash, the crypto crash, the recession's coming. We've got inflation. E-commerce companies on the stock market went down 85% in value. So the time not to sell for paw.com would be now. That's for sure, because it's a bad market for sale. The IPO window in 2022 is pretty much shut. It's pretty much closed. And when you see the IPO window closing, this is a time to build. This is a time to find a way to grow and expand. But when things are frothy and everything's going great, and you've been doing it, and you're starting to get to maybe the edge of that, then that also is a potential sign of a time to sell. I say 50% of the value of your exit is when you sell your company.
Exactly. And also it also comes down to your where you are in life as an entrepreneur and as an individual, what's your financial situation. Because try of course everyone try to maximize their value and always aim at the highest amount of money, and that's basically my job to optimize that amount of money. However, as an entrepreneur, to know if it's the right time to sell or not, if you get someone interested and you have an offer on the table, instead of trying to think, okay, can I get a better offer or more money, or if I wait a bit, try to look at the money, at the amount as an absolute. Because if you don't necessarily, if you don't have a if you're not a high net worth individual and you have someone offering you 5 million, it's game changer. So maybe you will wait and you could get 10 million, but you also take the risk that, yeah, a pandemic happens, a new product happens, and instead of 5 million, then you get down to one. And after tax, then it's not like getting 1 million is not as much a life changing event that getting 5 million. So just try to think of the impact of the offer on your personal well-being and personal life, to also make the decision whether to take the offer or not.
Yeah, I'd like to talk about this a little bit more, because it's a topic in the book that we're publishing next year with Forbes, called Start, Scale, Exit, Repeat. And 3 weeks ago, I had Michelle and I don't think, Jeff, you were there, but we had a dinner with the gentleman who started Reebok. And he asked me about my book, and I explained the concept. It's all about starting companies, getting to a certain level, sell the company, take some money off the table, and put that money away, start the next company, take some money off, sell it, take some money off the table. I call it laddering up. You're laddering up your wealth. And to me, it seems like a much more, in some ways, conservative approach. And he was the founder of Reebok, and his company, he spent 20 years of his life, the first 20 years, building the company up to $5 million, and then managed to launch aerobics shoes in the United States. And Jane Fonda wore his shoes, and literally he got the big break at that point, and his sales went to 30 million, 300 million, 900 million, and the company sold for $3.6 billion to Adidas. And it was the only company he's ever done. So he's an example of someone who just sticks with it. But the problem we don't, what people don't see is this Silicon Valley carnage, that occurs, and how many companies have tried to I'm working with one individual company right now. The founder spent 15 years of his life trying to build, and because they raised $60 million of venture capital, it's liquidation preference, which means they get paid out first. The entrepreneur's not getting anything, and so this concept that we can just start a company and go, and then things happen. Shit happens, right? We had the dot-com crash. We had the 2008 collapse. We've had the pandemic. We had the 2022 crypto crash, NFT crash, recession, inflation. We had the hurricane. We had the war, and The fact is, things happen. So when things are good and you're at a moment that you're ready to go, and things are they feel too good almost, we have to
Yes.
do it exact opposite of our emotions, which is say, okay, exit stage left.
Yeah, true. And I think what you're touching base on and explaining right now is survivor bias. The whole narrative of the Silicon Valley and of TechCrunch and all media related to fundraising and successful exits always showcase those great entrepreneurs with great story who manage to exit for several $billion. But then you keep that in mind, and as if you start having some success as an entrepreneur and you're having growth, you're thinking you're the next one in line, and you're the same thing can happen to you, because if you just sell now, you will never sell for multi-billion-dollar valuation. But then it fails to reflect the fact that that's one in a million. It would be almost exactly the same as you're making your first million playing poker, and instead of just withdrawing from the table, you decide to take that million and just put it all on 37 red. Sure, if that works out, then you're going to to have like exceptional success and people are going to talk about you. But the chances that you actually manage to turn it into like a 50, 100, 200 million dollar company is really thin. So depending on where you are in your life and your financial security that you have, I think it would be more prudent, statistically speaking, to get cash off the table. And honestly, that could be like a whole other topic. You have different ways to do that. You don't. It's not just black or white. You don't have to sell 100% of your company. You can also get cash off the table by selling 20, 30%, so that you secure that financial stability and you keep on growing your company, expecting a way bigger exit down the line. You know, that could be a good way to get a bit the best of both worlds.
Jeff, I know you keep trying to jump in.
No, I was just gonna, I mean, we probably have to do another session because there's so much we didn't touch on. One of the things I wanted to bring up and get Pierre's opinion on, but there's probably no time now, and I don't think we talked about it, is when you're structuring your exit, what are your thoughts on cash versus stock when you have the opportunity for both, if you're exiting to a public company, and earnouts, and structuring earnouts, and it's a whole nother, we could do a whole show probably just on that topic, Colin.
Yeah, I can give you a very quick answer. I've actually written like a full article on earnout, trying to define how do you best structure earnout and what to think of and understand how the buyer think in terms of earnout. So very short answer, the advantage of an earnout is to be able to bridge the gap between your valuation expectation and what the bidder is ready to give you. Because if they're ready to pay 10 million but you want 12, having an earnout may allow them to agree to a higher potential payout if you agree to condition it to certain threshold and certain performance.
Yeah,
Yeah,
that
then
makes
Pierre,
sense.
also, what about holdback? I know I'm working on a deal right now. It's a
Yeah,
10% holdback. Is that the reasonable amount or not?
I I think it's very reasonable, only 10%. Like honestly, especially now, given the additional level of risk because of the war, um, having anything more than 70% of the price paid upfront, I think it would be a pretty good deal. Like as an investor, as a buyer, I think I would ask at least 30%, either deferred or earnout based on a deal, just to protect myself from any downside that are outside the control of everyone around the table.
Yeah, I just find that a bit odd based on my historical deals. Like, I've seen as high as 20 and as low as 10%, but for holdback. But I guess if they're smaller, maybe, I don't know. You think that depends on size too, right? If it's a bigger company, there's better systems and audited statements and that kind of stuff in place. And maybe if it's a smaller company, there's more risk. Is that what you're thinking?
Just to be clear and make sure that we have the definition, for me, holdbacks are like a specific way to defer the payment, and they're here more to in case something happen in the company that was not uncovered during the time of the financial due diligence.
Correct. It's
Right?
not like an earnout where,
Okay.
and I've done that on the buy side, by the way, where somebody really wants to sell. I'll say, okay, I'll tell you what, I'll give you 20% down, and then, and I just did that. I do that sometimes when our businesses just aren't really taking off. I'll just take a 20% payment, and then I'll take, and the one deal I'm specifically thinking about is an advertising media company, and then we got a 5-year payout based on the revenue generated. Blah, blah, blah. So I agree. Sometimes I'll do those deals if my company just is struggling and and you do that with your competitor. But if you got a successful company, it's more along the lines of 10. I think around 10 to 20% holdback for 18 months or something like that for legal, warranties and that kind of
Yeah.
stuff.
But also, and that's kind of part of the job of the PE guys, sometimes they ask for things under a certain name, like a holdback, where obviously the less cash you can put up front, the easier it is, because effectively you're financing part of your deal through the cash flow generated by the company. So you may not call that a holdback, or you may call that a holdback. The reality is they want to try to put as less or the least cash up front as possible, because as a private equity fund, you're thinking in terms of IRR, internal rate of returns, which are impacted by the level of money you put up front and when you actually put the money and pay.
Well, this has been an amazing hour. And Pierre, I think we need to find a time for you to definitely come back
I would
and
love to.
drill more into this. I personally would love to hear more about, the very, very beginning conversations and how to move that along in a very productive way for both parties. So we've come to the end of our hour. Don't forget, you can join our email list and you can get alerts when amazing people like Pierre, um, Joe Foster from Reebok, and others are joining us on Startup Club at the Serial Entrepreneur Secrets Revealed. This show is every Friday at 2 p.m. Eastern, and we will be back next week. So please be sure to visit our website. You can check out the calendar as well as get emails. So, Colin, you want to
Michelle,
take us? Yeah.
yeah, I was just like, I know we have another big author coming in a week or two. I just went to schedule on Startup Club, couldn't find the um, I couldn't find the date, but do you know the date when he'll be coming on? And I know it's a good idea to go to the mailing list. If you sign up to the mailing list at startup.club, then when we have these big authors, we let you know. Right, Daniel? So we're going to let you know when Joe Foster's coming on. We're going to let you know when this next author, the other next author coming on is Mark Schrerin Brock. And he's a best-selling author of the book Nice Bike and dozens of other business books. He's famous author who's talked to thousands of or millions, I guess, of entrepreneurs have read his stuff and others. So he'll be on next. I don't know. I thought it was the 18th. I just can't find it right now. So
Yeah, I don't
either
see
way,
it either. We'll make sure that we get
yeah,
that updated.
yeah. I think that would be useful for the members so that we know. But get on that mailing list. I'm telling you, Daniel, you're gonna love it. It's we had Mr. Wonderful on, we had Jeffrey Moore on, we had Vern Harnish on, we had, and sometimes they come on the day before. They say, hey, can I come on your show? Okay, sure, let's just do something there. But and it's not just this show; it's other shows as well. So have a great week. We'll see you next Friday, 2 o'clock Eastern, and on the Serial Entrepreneur Secrets Revealed.
Thank you so much,
Thanks,
everyone. Be
Pierre.
well.
Thank you guys for
Bye
having me.
bye.
It was a pleasure.
Thank you,
Ciao.
everyone. Thank you so much. Have a good one.